Hello, I'm Chris Sarley, Investment Research Analyst at Fund Calibre, and today I'm delighted to be joined by Hugh Sergeant, Manager of the elite-rated ES R&M UK Recovery Fund. Thank you for joining us again today, Hugh.
Yeah, thanks for inviting me along, Chris.
It's no problem at all. Let's start with smaller companies. They always seem to be in the eye of the storm, but they've started to rally a bit in the last month. Could you maybe tell us why that's happened, and do you think it will continue? Are there sort of still some attractive areas there for you?
Yeah, no, good question. Yeah, I mean, we're positive about the outlook for small and mid companies, size companies from here. Obviously had quite a severe bear market over the last 18 months. The background to that was, first of all, I suppose their starting valuations were higher than normal, and they were also extremely popular, and lots of fund flows had gone into smaller companies, and then obviously the fundamentals started to deteriorate, the more exposed to downturn in the cycle. So those three elements have created quite a bear market in smaller companies, but we think all those three elements are starting to, significantly improve. The starting valuations for small cap are, really attractive again. The fundamentals we think are bottoming out. Probably peak anti-small cap was the same time as the mini budget crisis, and looking out towards next year, I think the fundamentals will be more supportive. And then smaller companies gone from being loved to quite hated. So a lot of the cash that was going to come out of smaller companies has probably happened. So I think the liquidity background will be more supportive of small caps. So are
the opportunities across the piece, or are there certain areas that are particularly attractive within small cap?
Well, as ever, our kind of hunting ground is in our, recovery value, some of the derated platform stocks. So, structural growers, which have become recovery type stocks. Those kind of areas are of most interest to us. There are some really modest valuations, still paying 3 or 4 times earnings. What some small cap have, rallied. There's still some hugely anomalous valuations. So I said 3 to 4 times earnings at the low point. So, but our hunting ground is that area. And actually, I would say that the hunting ground is probably as broad as I've seen in my career, because there's this additional element of derated structural growers alongside the classic deep value and recovery type stocks. So it's really attractive hunting ground for us.
Okay, let's go a bit further into that. You talked recently about certainty stocks being very expensive and uncertainty stocks being very cheap. Could you maybe just elaborate on that for the viewers?
Yeah, I've talked about that, various times over my career, because we've had 1 or 2 cycles, it's fair to say. And when you have, difficult negative cycles, which we've been going through over the last year, all sorts of uncertainties, that has meant that the average investor has wanted to put their capital into stocks which are seen as more certain. So where revenue and profits relatively certain in the context of an economic downturn, or all those other elements of uncertainty out there. So the likes in the UK of AstraZeneca have been natural recipients of the capital that's looking for more certain stocks. The uncertainty stocks, which is anything which isn't the above, I suppose, anything that's perceived as exposed to the economic cycle, anything that's had those kind of exposures has been significantly derated. So there's a huge valuation gap between certainty and uncertainty stocks, and the world will become less uncertain over the next couple of years. Don't know exactly when the low point will be, but it will become less uncertain. And a little after that, the uncertainty stocks, which is is a huge hunting ground at the moment, they will do well. And I think there's some indication that started to bottom out.
Well, let's turn to the portfolio in a bit more detail. One area you have been adding to recently in recent months is real estate companies, particularly in London. Could you maybe give us a rationale for that, please?
Yeah, real estate, we were slowly building up from an underweight position, but the big catalyst was the shock to the system created by, the go for growth mini budget, and the fact that made bond yields and corporate, both sovereign debt and corporate bond yields spike up very aggressively. And obviously real estate is to a reasonable extent valued off those. And as a result of that, you saw real estate stocks, which had already been weak, come back another 20 or 30%. So they ended up trading at 50% plus discounts to their underlying assets. Obviously, the NAV, as bond yields move up, will fall. But from our calculations, it wouldn't fall more than 10 to 15%. So we're buying those stocks on a very big discount to kind of more realistic estimates of value. Actually, for the first time in my own personal investing career, I've been a relatively aggressive purchaser of sovereign debt and corporate bonds. As yields on sovereign debt moved towards 5%, felt that was quite attractive. So it made sense at a portfolio level to look for sectors that had been derated on the back of those moves. So real estate, and in particular, as you mentioned, London. Just people have got London's a great city with some fantastic real estate, which will remain popular forevermore, really, and where with a very depressed sterling, over the next year, 18 months, you're likely to see some strategic buyers from outside the UK become interested in some of our fantastic assets. And one example is Capco, which I've held for a while, but just, it's just completely the wrong price at the moment. Owns, big chunk of Covent Garden, and with its merger with Shaftesbury is owning up, is going to be the owner of Carnaby Street, etc. So just a fantastic real estate asset, which trades at half NAV. And is strategically valuable asset.
And just finally, then, given what you've said there, could you maybe give us a bit of an outlook beyond those couple of quarters, what you're looking to do? And I mean, the name of the fund perhaps gives it away slightly. You mentioned the defending nature you've sort of taken on the fund. Are you very much in a recovery positioning now rather than recession position? Are you sort of looking towards the upside now?
Yeah, no, I agree. We as a recovery fund, I suppose we're never the best position to be full on defensive, but I think, as I mentioned, we've done reasonably well in the context of big drawdowns elsewhere over the last year. Definitely, it's right for us to be moving on to the front foot as a recovery fund at the bottom of the cycle. It's right to be looking for classic recovery value, multi-cap, and also the area of out of favor structural growers, to be looking for opportunities in that area. And I think the fund's well positioned to benefit from bottoming out of the cycle and a move into the recovery phase of the cycle whenever that happens over the next couple of quarters. And we'll be gradually applying more capital to follow that theme.
Hugh, once again, thank you very much for your time, and thanks for joining us.
Thanks very much. Thanks for all your questions.
No problem. And if you'd like to learn more about the R&M UK Recovery Fund, please visit fundcalibre.com.